Welcome back to another top-notch video. In this week's videos, guys, we're going to be talking about the week of the 28th of January through 1 February. If you wonder what this channel is about, it's all about the TSP, Roth IRA, 401k. We go over the general market indices and we just talk about them and kind of their trends and what they're doing. For TSP users, that's the CSI and F fund. Roth IRA, that's IVV, VXF, EFA, and AGG ETFs. We got the S&P 500, the small caps, international markets, and bonds. With that being said, we kind of do a very general overview and analysis and then go more into the details for each fund. So let's hit that right on up. This week with the S&P 500 or the C fund, we saw quite a good rally with that. We're just going to go through a couple charts and kind of our strategy of where we're at with that. This is from CCM Market Model. They do their own YouTube channel. You can go ahead and check them out. We just wanted to grab a couple of their charts. So as you can see, we bottomed here in the end of December. We decided for fourth quarter, we basically had a buy and hold strategy. We weren't around for a lot of this because we were moving in the moving process. So we just had a buy and hold strategy. We ended up coming all the way down to this retracement line here, and we had a buy and hold strategy all the way till the about 14th of January. Around the 14th of January, we decided to move our allocation to the G fund just because we were based off of some trend lines and some things we saw in the data. And it ended up hitting, supporting on this trend line here and then moving up higher. Typically when markets have a V bottom, or when they have a bottoming process, there's numerous ups and downs. As you can see here, we have right here, and right here. This could be just another ups and down process. We're going to go based off of charts and show you guys a little later on why we have that. But that's basically where we ended up getting out and our reasoning for getting out here, kind of on this retracement line. So here you can see another chart. This is also the S&P 500. The long-term trend is currently going down here with RSI. Typically when you're all the way up here in the green, you can see usually a retracement to head back down. We are getting close up there again. We are above our trend line. So we're just around a very interesting area with the markets. And with markets, they seem confused, and even the Fed seems confused. We had the Fed meeting this past week, and their comments were completely different from the meetings in February. So just like almost a complete reversal. So things are we're just at a very confusing point. So it's very important that you pay attention and be watching these videos for what might be happening. This is, again, a huge move. We decided right around here to get out, and we did see some resistance a little bit higher, but we could see some more resistance in this area. I think if we end up breaking this area here, the 200-day moving average, we could move back in. We'll take about a 4% hit for that. But overall, I'd rather take that than if we were to plunge back down to the lows here. So that's what this chart shows. Here's another really good chart that shows that the 200-day moving average, once again, this is the CCM market model, isn't everything. If you look back in 2015, we moved the orange line here is the 200-day moving average, and we moved above it once, twice, 3 times, 4 times before we ended up doing lower lows. Now with the 200-day moving average here, we did move above that once, twice, and we could be hitting that again or not. It's not just this, I guess, magical thing where if it hits it, it's going to end up being resistance or not. As you can see, it varies around this line, but it's a very good indicator of where things can go based off our data and our charts. We'll have to see what we want to make move-wise with this. But as you can see here, we have the 14th. Markets moved a little bit higher off of that. This is a good reversed head shoulders look. It could be a very, very good look for heads and shoulders. That's a chart pattern. This is to be determined. We don't know what could happen with this. It could continue to move higher, and we could move it to rally, and at this point we might end up putting our allocation back in, or we could see something of a retracement back down to this level, and we'd want to get back in around that level as well. So we'll just have to wait and see where things are at. Like I said, with this down sloping trend, we're just kind of waiting to see where to go. And last of all, we have our retracement boxes for 2019. So this is, again, the S&P 500, the C fund. Kind of just going over very general of the C fund since it's one of the major indices. As you can see, we have our boxes here. right around September, October, we went above the box and we sliced right back into that box. We jumped all the way down here and went below this box here. Not a super good chart because usually when we have a box, it hits the resistance on this box line. But right now we're kind of right in this area here, right in the middle of the box. We don't know if we can test the bottom of this box or test the bottom of this here. We're kind of waiting and seeing. A very good entry point would be here if it hit this, or if it hit here. That'd be a very good point to re-enter. Even if it came down and retested the lows, very good point. Now if it continues higher, like I said, we get above that 200-day moving average, we'll have to say that we were long and remove our allocation back into those stock funds. That's just a kind of a general overview of the S&P 500. That being said, let's kind of move into what we have. So the S&P 500 for the month of January did very, very well. As you can see, we're up almost 12% in that S fund. We are sitting currently right around 7%. If I pull that up really quick, just to show you guys. Yes, for this year, we are sitting right around 7% for our allocation. So that's not bad. I mean, 8, 9, 10, 11. So we're about 4% behind. Like I said, I think with a bottoming process, there's a lot of leeway room in here for us to basically do things up and down. So we'll have to see where that goes, but we're, about 4% behind for the most part. With that, I would say, looking at the TSP talk, they do some basic comments and whatnot. They mentioned that the jobs report that came out for January beated expectations, which was huge. And also they're talking about the Fed for whatnot. Fed's been real confusing, like I talked about earlier. Here is the S&P 500. As you can see, we did or the C fund, okay, with us. As you can see, there was some resistance here on the 50-day moving average. That's kind of right where we pulled out. We thought it was a very good place to kind of pull out in this area. Things did continue higher. Now we're testing that 200-day moving average. We'll have to see where that goes. But with both of those last time, we did see a little bit of a decline. So we're just going to have to go based off our chart data. Here's a really, really good chart that one of their members posted. And again, this is TSP Talk and Tom. He does these comments here. They get it from stockcharts.com. They do a very, very good job. As you can see, here's the last two big bear markets from 2000 and 2008. Every time they had a trend that broke the trend model, we saw kind of a retracement and a retracement, and then we saw it break down basically all the way to the 200. So here is the dot-com bust. We saw a retracement here, and then it broke down to the 200-month moving average. And we saw kind of a rally here again, saw a retracement, and then bounce down, even go below the 200-day moving average, and then continue upward for the most part. With that continuation upward, here you can see our current trends and our current daily charts. With that, we broke this line of retracement here. Could we see it come down to the possible 200-day moving average? Yes, and that's why we're just being cautious. So we don't know if it's a possibility, guys. We don't, like I said, markets are really confused right now, and I'd really like to see it get above this trend line again, or above the 200-day average, to kind of improve our data and our charts before we jump right back into the markets. We did very good for the month of January, making over almost 7%, and that is one of the best months we've ever had on file here with TSP, with the Top Notch channel. 7% for one single month. So just keep that in mind. With the Dow Jones, we're also approaching the 200-day moving average, or the S fund. Okay, with the I fund or EFA, we still really think that this is kind of a broken chart for the most part, and we need to see this chart also get above the 200-day moving average. With the AGG, we are above our 200-day moving average. We're doing very well on AGG. Could see quite a big turnaround. Basically, we didn't really see much in January, but we could see a rally now into February. We will keep this chart in mind as always, but as always, we're not a huge fan of bonds. We're more about stocks on this channel. So we'll have to wait and see where that goes. With that being said, we're going to move into Grow My Thrift Savings Plan. That's another update kind of overall charts. Kind of say the same thing with the S&P 500 or the C fund. As you can see, they have RSI, MACD, and Williams percentage R on here. As you can see, when Williams percentage R is in the green, that's a time when typically the markets go down. Right around mid-month, we did pull out and kind of saw this coming down, and it ended up staying in the green, but we don't know how long it will stay in the green for. MACD is doing pretty well here, and RSI is headed back up. Typically, you want to buy in when it's real low. For the most part, we're going to see if it hits this 200-day moving average and what it's going to do from here. Like I said, if it consolidates above the 200-day moving average, I think that'll be a real positive sign for us to get back into charts. But as you can see, right around this period here with these resistance, the 50-day moving average coming up, we decided to get out. We saw some resistance. It blew through it and then acted as support for the market. And now we're approaching that 200-day moving average. If we see something like this where it blows through it and then consolidates on the other side, I think that's a very positive sign for our markets and moving above. But as you can see, guys, we had we have a high here and then a lower high, and then about the same equal high here, and then a lower high here, and then a lower high here so far. So we're just not super confident with our charts, and we'll have to continue on and wait on that. Again, with the Dow Jones or small caps, the S fund, getting close, getting ready. We're almost 3% away from the 200-day moving average. Kind of waiting to see what will happen from here. This 200-day moving average, as I mentioned on charts early, isn't some kind of magic line where it will hit that. We're pretty happy with our positions that we ended up with in February. We were in the S fund, so right around here is where we pulled out, kind of around this resistance line, just to kind of see where things happen. We didn't get a retracement at all. Usually with a bottoming process, we see increased volatility, a lot of just kind of seeing where the market's at. People are feeling it out, and we didn't see that, so that's all right. We'll continue on. Hopefully maybe this will come back down and retest this. If it were to do that and the data was pretty good, we might jump back in there and end up with not much of a loss for this month for what markets did. EFA, like I said, we have to see it hit about that 200-day moving average. We're about 3.75% away from that. And then, of course, that's all we had from them. So moving into our own analysis, let's go into the S&P 500 here. Like I said, we're getting, like all those other charts I showed you already, IVV or the C fund is starting to get very close to that 200-day moving average. It's very flat right now. Flat meaning we don't know if it's up or down. Kind of a hard part for trend followers, but we are at a bar here. So just a lot of resistance in here, guys, with some of these bars and charts. If I pull up our chart here, which we base all of our data off of some of these data points here, we did see a weekly chart come through here, so this is a very positive sign. On a 2-day chart, though, we are starting to decline. What I would like to see is hit that 200-day moving average and see kind of a fake out here, sort of like we saw back here, and then I'd be more than willing to jump into this fund and support it going forward. Even on a 4-hour chart, it looks like we're doing pretty well here, but we're a little bit out of our Bollinger Bands, and that does make me a little nervous on the smaller, shorter term charts. So I would just like to see a change around on our 2-day chart, and I would be very happy, very, very happy. So that is the S&P 500 or IVV ETF. That is the C fund. Let's move into the S fund or VXF ETF. Same kind of scenario or situation we talked about already with a number of our charts. See this giant V bottom. Typically you don't see a very big V bottom. You see some kind of consolidation process. We're seeing a little bit of that here and nothing of it really right here. I would say we might see some of this more on a bigger scale coming up. I don't know to say that for the truth, but if we look at our charts, here we have the S fund on our charts with a weekly chart. We are doing very well on the positive side. We just came out of this very negative period here for all of fourth quarter of 2018, jumping into a very, very nice quarter. Every week's been up so far, but if we look at our 2-day chart, we are on the decline a little bit. Price is not reacting to that. This is a much better chart. We're in our Bollinger Bands, but what I'd like to see is a fake out, something like this here, in order to jump back into this fund. And even when we had this fake out back in November, if you would have jumped in on this fake out, we only had 2 weeks, and then we ended up having just an awful December, and it stayed out of the Bollinger Bands for 1, 2, 3, 4 weeks. Kind of rare to see that. So markets are in a very interesting point. It's hard for a technical trader to look at some of these markets on a small term chart, very, very short term. We are out of our Bollinger Bands up here again. So like I said, I need to see the 2-day change around before we get back into our position. Right now, if you're not aware, the Top Notch channel is in G fund position, just short term, to kind of see where markets go. Sitting at 7% return, we thought that was a pretty good return. Try not to get greedy, and markets are at 12%, so we're about 4% behind on our top TSP fund right now. Moving into EFA, this is just so below its 200-day moving average. We are not confident with this fund until we can retake that. Hopefully we'll do so on our charts. When we look at EFA, we are sitting at, we're above the positive line here. We haven't seen this cross, these lines cross for a very, very long time. Not like this anyways. We saw a little cross in September and not much in May. So this chart has been negative ever since the beginning of 2018. So that is a good change. We could see some bottoming process here, but like I said, we need to see it hit that 200-day moving average to move forward. Moving on, we can look at the 2-day too real quick. Again, declining. All of our 2 days are declining. We need to see some positivity on these declining charts. The DO, or the delivery rate oscillator, is 539 here, and it's moving down. Okay, so we just need to see some positivity on that. Moving into our last chart, which is bonds, AGG ETF, or the F fund. Saw a beautiful rally from November all the way into 2019. January we saw some consolidation until the end of the month here. Then we saw it kind of spike up to this trend line. With that spike up to the trend line for AGG, we are sitting right around, starting to move down on a weekly basis here. Price has not reacted to that yet, but typically when we start to decline here, like we saw back in September with our stock funds, we got to be careful because it can start to decline very quickly. This is good news for our stock funds, so hopefully we see something good with that moving forward, and we'll just have to see where things go. So that is AGG. We went over all of our funds. If you guys have questions, concerns, or comments, please go ahead and write those in the comments below. Really appreciate you guys watching the channel and whatnot. As you can see, for us, we are still sitting in that G fund 100% with a great January return for the channel. So if you were paying attention and had your money where we did, you also had a beautiful return for January. We'll just see if this volatility picks up or not. Granted, no one can be 100% right with markets or 100% wrong. So if we're wrong, we will see the data improve on those 2-day charts. We'll jump back in. And if we're correct, we'll wait for that retracement to come back to hit some of those retracement lines, and we'll jump back in and grab some of that profit that we missed out on. Once again, I really appreciate your guys' time. This is another top-notch video. Have a great week. We'll see you guys next time.